Let's talk about two growth companies that should be on everyone's watch list and maybe even on your buy list if you're interested in those. Now, one company is up over 500% in the last 5 years, while the other is actually down 61% in the last 3 years. Both companies operate in completely different industries, so you can pick whichever you like more. Now, company number one is called Grab Holdings. It has a market cap of $16.48 billion, went public through a SPAC. So yeah, I'm not surprised seeing the stock being down 61% in the last 3 years. Year over year, you can see that the stock is up 27.22%, with the big move coming after the August 5th crash. Currently, if we look at what the analysts are expecting, they're expecting revenue to go up close to 17% year over year in fiscal 2024, while still being unprofitable. But then in fiscal 25 and 26, you can see that the analysts are expecting this company to become more and more profitable, while still growing 15-16% year over year sales-wise. If we currently look at the average analyst price target, that sits 13.37% higher than the price we're at today. If we look at some pricing metrics, of course, it makes no sense because, well, the company is still unprofitable, but hey, for the sake of this video, this is basically what you get: price to earnings, EV to EBITDA, price to sales, and price to free cash flow. From a price to free cash flow perspective, this is in the last 12 months, it's not that expensive, 34.5 times for a company that is expected to grow 15-16% year over year revenue-wise and becoming more and more profitable as well. For those that don't know what Grab is, it's basically an Uber type of app, but a super app in Southeast Asia. I'll explain a bit more in a second. If you enjoy this type of videos, leave it a thumbs up, subscribe if not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So like I said, it's basically the equivalent of an Uber, but in Southeast Asia. Now, what's interesting also is that, well, a couple of years ago, Uber sold its Southeast Asia rideshare and food delivery business to Grab, and Uber has taken a 27.5% stake in that company. But since then, that stake has come down a little bit. The last number that I found was 14%. Now, what does Grab do? Well, unfortunately, we in the West, we don't really get much super apps, right? In Southeast Asia, in China, you've got those apps which you can basically do a lot, if not everything you need. So they offer mobility services, food delivery, logistics and delivery, financial services, e-commerce and grocery delivery, travel services, promotions and rewards. Basically, all you need is this app to go through your day. Whether you need transport, so a bit like Uber, but Uber Eats as well, all in the same app. Then there is also Grab Pay, so you can pay for stuff through that same application. You can even shop e-commerce wise, you can shop through that. You can send money to friends and family as well, save, etc., etc. So really a super app. Now, financially, how is the company doing? Well, these are the numbers from their previous quarter. So on-demand GMV has increased 13% year over year to $4.4 billion. Group MTU, or monthly transacting users, reached 40.9 million. That's up 17% year over year. On-demand MTU increased 19% year over year to 36.7. If you look at the financial measures, revenue is up 17% year over year. Operating loss improved by 68%. Total segment adjusted EBITDA improved by 84% year over year. Then adjusted EBITDA, net cash from operating activities, and adjusted free cash flow all went from negative to positive in Q2 2024. If you look at the outlook, they expect 2024 revenue to be between $2.7 to $2.75 billion, representing between 14 to 17% increase year over year. 2024 group adjusted EBITDA of between $250 and $270 million, and adjusted free cash flow to be positive for the full year. So if we look at free cash flow, total revenue, what has happened before and what's expected in the coming years, we've seen the year-over-year growth already previously in this video. And then from a free cash flow perspective, it's basically expected to be flat with some slight growth in the next coming fiscal years. Looking at gross profit, net income, operating margin, and gross profit margin, I mean, it's pretty clear there has been an inflection point when it comes to gross profit right here, Q4 2022. And since then, it has continued to increase by quite a lot. We also see that net income has improved quite significantly as well. These are in the last 12 months. So yeah, we are reaching that point of break even and then profitability. And the same will happen with the margins here. So operating margin and gross profit margin have all improved throughout the last couple of quarters. Looking at the stock right now, we can see that since June of 2022, the stock has been making higher lows. And then more recently, it has broken out, right? You can see it went over the 200-day, the 50 and the 20-day moving average, and even above that $4 mark, which was previously a sort of resistance. Now we are sitting above that big green candle here. And on a weekly, yes, RSI is showing us that it is a little bit overbought right now. But as we've seen with plenty of other stocks, you can stay overbought for a long period of time. Plus, in the next coming weeks, they're going to report their Q3 figures. So that could definitely move this stock. But Grab is, in my opinion, very, very well positioned, especially in Southeast Asia. They're basically the dominant player there when it comes to delivery, food delivery, transport, and then, well, the fact that you've got a super app that puts you in a very, very lucrative position, especially in those geographies that are expected to grow a lot in the coming years. And to be honest, this is the type of stocks and companies that shouldn't really go under the radar just because it went public at, well, for them, the right time, because they got a huge, huge valuation. But unfortunately, after that, you have to show that, well, that valuation is justified. Clearly, that did not happen, and so the stock completely crashed. But just because it was once extremely high and now it crashed does not mean that you should not be looking at these types of companies. So this is Grab for you. Very, very interesting. Let me know what you think down in the comment section below. Moving on to company number 2. Company number 2 is a company operating in a completely different industry, and that company is called TransMedics. It's a commercial stage medical technology company focused on transforming organ transplant therapy for patients with end-stage organ failure. Their flagship product, the Organ Care System, or OCS, allows for the preservation and transportation of organs in a more viable state compared to traditional methods. It was founded in 2006, and TransMedics aims to improve patient outcomes by enhancing the organ transplant process. As I said at the start of this video, this is a company that has performed much, much better than Grab. In the last 5 years, the stock is up close to 600%. Over the last year, the stock is up close to 200%. And year to date, the stock is up 55%. But as you can see, there has been a retracement here since the end of August. This is a company with a market cap of $4.1 billion. It is profitable and it is still growing very, very quickly. If we look at the average analyst price target, that sits close to 48% higher than the price we're at today. Looking at some pricing metrics here, so forward PE sits at 80.7 times. It has been decreasing quite fast. EV to EBITDA 41.4 times and price to sales 7.9 times. Of course, all below the 5-year, 1-year and 2-year mean, because this company is one growing extremely quickly, top line, but bottom line as well. And now with the small retracement that we've seen in the stock, that definitely helps with valuation. So what has happened in the last quarter? Well, total revenue increased 118% year over year to reach $114.3 million. They generated net income of $12.2 million or 35 cents per diluted share. They owned 15 total aircraft and they purchased 2 additional aircraft in July 2024. Now you might ask, why they're purchasing aircraft? Well, because you have to transport those organs as quickly as possible. TransMedics is raising its full year 2024 revenue guidance to be in the range of $425 to $445 million, which represents 76 to 84% growth compared to the company's prior year revenue. And the prior revenue guidance was $390 million to $400 million. TransMedics is also the only FDA-approved multi-organ platform with its 3 current offerings, OCS Lung, OCS Heart, and OCS Liver, which you can basically see here on the screen. Now, looking at what has happened before, of course, you can see that it took a while until this company got going, right? Revenue was basically not really moving that much in the last couple of years, and then the inflection point basically happened in 2022. You see a revenue growth of 208%, then 158%, 137.5%. That's in the last 12 months. And this year, that's expected to be 84% revenue growth, followed by 31% and followed by 19% in fiscal 2026. By then, free cash flow should be positive. If we look at the two revenue segments, we can see that net product revenue has increased 655% since Q4 2021, and services revenue, well, that has increased by 24,796% since that same quarter. Looking at margins, gross profit, net income, well, one thing we can see here that's gross profit margin that has actually come down a little bit in the last couple of quarters, but operating margin has increased, gross profit continues to go up, and net income has become positive, and all of those are in the last 12 months. And we also recently had some analyst commentary on this company. So Bird, I think, started coverage of TransMedics with an outperform rating, commenting that the company's organ care technology has driven a paradigm shift and accelerated growth in the organ transplant market. With tmdx still in the early innings of capturing share and driving further market expansion, leveraging its novel NOP service model, we have high conviction in best-in-class, over 25% revenue growth upside, and improving profit outlook ahead. The analyst firm has set its price target for the stock at $200. Another analyst at Needham has launched coverage with a buy rating and a street high price target of $208, expecting the organ transplant company to generate profits this year. tmdx should turn profitable in 2024, and we expect rapid improvements in its operating margin, EPS, and cash flow in 2025 and 2026. They're highlighting the company's organ care system, or OCS, a portable device for preservation of donated organs. And so looking at the stock right now for tmdx, we can see that since the top right here in August of this year, the stock has dropped around 30%, and we are also under the 200-day moving average. So let's see if we can recover and end the week above it. I think if we can get a rebound just like we've had here back in March of 2024, I mean, that could be a great entry point if you're interested, of course, in this industry and in this company. RSI is neutral-ish, but of course, the momentum is not with the stock. But with this one, again, if you're really interested in that, I think there could be a great opportunity to buy now that the stock has retraced by 30% since the highs in August. But of course, you might also want to wait for the earnings report, which will happen next week. So overall, that's the two companies I wanted to cover today on the channel. Of course, we're going to cover more and more companies, some that we have covered before and some new ones as well. Hopefully you appreciate all of that. If you do, hit the like button, subscribe if you're new here. We really appreciate that. And I see you all in the next one. Bye-bye.